Good morning and welcome to Charting the Markets on Monday, the 4th of March. The Nikkei 225 hit another record high above the psychological 40,000 mark earlier this morning, having already done so on Friday as tech and also AI stocks such as Tokyo Electron helped the index to hit those record highs. And as investors keep on leaving Chinese equity markets for Japanese ones. Now, for the time being, the trend is still very much pointing upwards, but we're starting to lose some upward momentum, as you can see here on this daily financial bet. Today, we've got a slight red candle here, having made intraday a slight intraday high. We're starting to come off again, as investors are slightly worried about potential inflation data out of China, of Japan this week, and also the yen perhaps weakening, which is currently pushing the index higher. But if it were to strengthen in the future, as the monetary policy by the Bank of Japan finally pushes towards a first rate hike, which may happen as early as April, we could see the Nikkei 225 top out slightly. So that is something that could happen from a fundamental point of view. From a technical point of view, we are seeing this slowdown in upside momentum, but we saw that already back in February when we make a record high. So it wouldn't be surprising if something similar were to happen again here. The difference being now that we've traded and risen above the psychological 40,000 mark, and since it's a round number, I wouldn't be surprised if we were to indeed at least short-term tap out in that area. Now, if that were to be the case, we could slide back down again towards the 39,638 high, the 23rd of February high. And then we've also got this February to March uptrend line in play at around 39,370. And below there, we then have, if I go onto a monthly chart, the 1989 high, which was made at 38,951. So that's really the most important support level if we were to form a minor top in this place here. For a medium-term top to be formed, we would have to fall through the mid to late February lows at 38,104. So we're a long way from where. And for the time being, we have a series of higher highs and higher lows, which is a definition of an uptrend. If we were to therefore rise above last Friday's high at 40,355 and the high we saw earlier this morning, then we would most likely attack the 41,000 mark. Looking at the FTSE 100, well, it isn't doing as well. As you can see here, it's still lagging all these other indicators, which indices, I should say, which are making record highs, such as the Nasdaq 100 or the S&P 500, the DAX 40, the CAC 40 in France. All of these have made new record highs, but the FTSE hasn't. And once again, it struggled around the 7,000 mark. As you can see here, we've had a slight downtrend line in place here for the last 3 weeks, and we topped out there earlier this morning and are sliding back towards the orange line here, the 55-day simply moving average at 7,640. Now, since we've seen a three-legged correction, which is possibly an ABC Elliott wave correction from the 20th of February high at 7,750, it still is possible for us to head back up towards these highs and also towards the highs seen at 7,769 back in December of last year, provided we stay above the 7,596 low we made last week. Moving on to US markets, you can see here that the S&P 500 trades once again in record highs. As you can see here, we rose to 5,141 on this daily financial bet, as investors continue to pile into US stock markets, as the US economy remains strong, and as inflation is continuing to head down towards its 2% target that the Fed has in view. Now, we can see here that we are still rising, and the relative strength index is also rising. But for the time being, there is still the possibility that compared to the early February highs here on the index and also on the oscillator, we may see a lower high, which would mean it's a negative divergence. Now, we're not seeing that at the moment. We saw it last week, but with the new high we saw last week, that was then negated. But if you look at the wedge formation, which is being formed here, plus this possible negative divergence, it is saying that perhaps we could see a loss of upside momentum again, like we saw last week. The question then is, will it take us back down again towards this uptrend line, going back to the low seen back in October? And this is currently seen around 5,030. Or will it just be a short-term retracement lower like we saw last week before we head into new all-time record highs? That's really the big question. Now, for the time being, as long as we stay above last week's low, which was made at 5,054 on the S&P 500 on this daily financial bet, the trend is your friend, and that's still pointing up. If we were to rise above 5,141, we could then engage the 5,200 mark. Don't forget, we've got the testimony by the Fed Chair, Jerome Powell, out this week. We also have PMIs in Europe and in the US, I believe, as well. And then obviously all these different labor data sets ahead of Friday's non-farm payrolls in the US, which will also be followed closely by the financial markets. But right now, as I say, as long as we stay above 5,054 on this daily financial bet, the S&P 500 uptrend very much remains intact. The US dollar came off over the course of last week after having regained some of its lost ground towards the beginning of last week. As you can see here, the inverse of that is seen on the euro dollar chart. So we had this down move in euro dollar take us down to Thursday's low 107.96 before we then had some US dollar weakness, basically taking the currency pair back above the red line here, the 200-day simply moving average at 108.31. And we are currently gaining momentum, and we are heading above the late February high at 108.65 and attacking the 55-day simply moving average at 108.80, and are also heading towards the 108.89 high seen at the end of February. So further upside seems to be in store now that we've taken out these highs, and some of these highs at least, and also have risen back above the 200-day simple moving average. So for me, from a technical perspective, as long as we stay above last week's low, further upside is likely to be seen in regards to this currency pair. And the real test will be whether we can rise above the February high at 108.97. And if so, we could then head back up again towards the mid-December high at 110.09. So here again, also further upside most likely in store, so meaning US dollar weakness could be seen in the short term. But there is also euro strength ahead of this Thursday's ECB policy meeting. As you can see here, the euro is appreciating against the British pound. On Friday, we rose to 85.76, very close to the 85.78 February high. And if we were to rise above there, we would probably be leaving our sideways trading range we've been in since the end of January and head back up again towards the red line here, the 200-day simply moving average at 86.11. This bullish view remains intact whilst we stay above the last reaction low of note, and that was made on the 23rd of February at 85.28. For those of you who watch this column quite regularly, basically a relative low is simply a low on the daily candlestick, which is lower than the one to its left and to its right. So that was made on the 23rd of February at 85.29. Provided we stay above there, we should continue our gradual advance with regards to this currency pair. And another interesting one is euro yen. And as you can see here, the euro is also appreciating against the Japanese yen, which last week it appreciated briefly on comments by the Japanese finance minister talking about the possibility of rate normalization taking place in Japan. And this may happening, well, investors thought it may happen earlier than expected, with a 10 basis point rate hike to be seen, the first since 2006, I believe, in Japan. And therefore, we had an appreciation of the currency. But since then, the verbal intervention we basically saw last week has come to naught, with the euro yen heading back up again towards its 163 yen and 71 sen late February high. and this will remain in play as long as we stay above last week's low at 161 yen and 69 sen. The gold price has benefited from the weaker US dollar and also from the fact that basically the hopes for peace talks in Gaza with regards to a ceasefire have once again broken down. And you can see here this huge surge in the gold price, taking it to a 2-month high at $2,088 per troy ounce on Friday. And that, incidentally, was the high last seen in late December of last year. And if we were to rise above there, which looks pretty likely given the strong advance we saw on Friday of last week, the gold price is likely going to head back up again towards its December record high at $2,121 per troy ounce on this daily financial bet. And also because we've broken through this downtrend line, which, if I draw it on here correctly, would actually go back to this previous high going back to December, and we've clearly broken through there and are looking very bullish indeed. In case of minor retracements being seen, though, we've now got the mid-January and early February highs between $2,065 and $2,062 per troy ounce, which should act as support as this uptrend continues. The silver price has also benefited from flight to safety flows. As you can see here, we broke through this immediate accelerated downtrend line and have risen all the way up to the 200-day simple moving average in red here at $23.28 per troy ounce, which capped the advance in the silver price on Friday. And again, here we were testing also a resistance line going back to the late December highs. And if I now redraw it correctly, that one, as you can see here, is currently being broken through here. And the broken through trend line now acts as a support line together with the orange line here, the 55-day simple moving average at $23.05. So the odds are that further upside is likely to be seen, and a rise above Friday's $23.27 high should then retest the mid-January and also the mid-February highs between $23.50 and 53 cents. And a break above there would confirm a major medium to long-term bullish trend reversal, which could then take us all the way back up again towards the December highs at $25.77. But we have to break through this $23.50 to 53 cents resistance area for this to be the case. And last but not least, let's talk about the crude oil price, about WTI. And you can see here that on Friday, we also broke through some key resistance going back to the mid-November highs as OPEC Plus decided on further output cuts for another 3 months. And you can see that led to a breakthrough, this key resistance area between 79.62, I should say, and 79.66 on this front month futures contract. And intraday, we went up to 80.48, but then we slipped back into this resistance area for the daily chart closing basis. So what I would like to see this week for this break to be confirmed is another rise above this resistance area, and also ideally a rise above Friday's high at 80.48 and also a daily chart close above there. Once that has happened, or if that actually does happen, which looks pretty likely to be fair, we will most likely be forming a major bottoming formation, as you can see here, which is taking several months to happen. And that could then take us all the way back up again, not just to the late October high at 89.77 and the psychological $90 mark, but also towards the September high at 94.25. So there is a distinct possibility now that we're trading back above the red line here, the 200-day simply moving average at 77.80. And as long as we stay above there, the trend is your friend, and that is pointing towards further upside being seen with regards to the oil price. Thank you very much for watching Charting Markets with me, Axel Rudolph. As always, if you want to know more about what I publish, the research I write, and the technical analysis I look at, please just follow me on X. Have a lovely weekend. Have a lovely week, I should say. I've just come back from my weekend. Goodbye.